Hello friends, welcome to my YouTube channel Jupiter Finance. Today we'll be speaking about ULIP insurance plans versus mutual fund SIPs, which is better for you. ULIPs are nothing but unique financial products that combine the benefits of life insurance coverage with investment opportunities. A portion of the premium goes towards life cover while the rest of the amount is invested in mutual market linked funds. Systematic investment plans are same as ULIPs, only the life cover part is missing. The entire amount is invested into the markets. ULIPs offer a dual benefit of insurance plus investments. So ULIP is a more comprehensive protection, whereas SIPs is a purely investment focused investment product. For example, in a ULIP, upon the policyholder's death, the nominee receives either the sum assured or the fund value, whichever is higher, providing a significant financial cushion. Say, for example, you have a particular target in your mind. You want to invest, if you have a life goal of, say, in accumulating a corpus of 50 lakh rupees, and for that you have a SIP of 5 lakh rupees for each of the 10 years, 5 lakh rupees for each of the 10 years. So if something happens, something by touch wood, something some unfortunate thing happens, and if death occurs, then you will not be able to meet your financial goal. So in case of ULIPs, what you can go for is you can go for a rider which is a waiver of premium benefit. So even though something goes wrong with you, the goal of 50 lakh rupees which will be achieved. So that ULIP waiver of premium rider is very important, which you don't get in SIPs. The tax advantage is very important. In ULIP, the entire capital gains portion is tax free, provided the annual ULIP premium is not exceeding 2.5 lakhs. In case of SIPs, you will have to pay the capital gains, or either STCG, short-term capital gains, or long-term capital gains. Another important point is whenever you are switching between debt funds and equity funds, especially those index funds traders who have a habit of exiting at Nifty 25,000 levels and jumping onto the debt funds, and whenever the Nifty dips to 24,000 or 23,000 debt levels, then jumping back from the debt fund to equity, doing switch between debt and equity funds. Every time they do a switch between equity and debt funds, they have to pay tax. Whereas in case if you switch between the different schemes of ULIP, you don't have to pay any tax. So that's another advantage of ULIP. Investment flexibility and fund switching. There is absolutely no charges, or there is no hassles, or there are no taxes when you switch between different schemes, say debt schemes or equity schemes in ULIPs, which is not the case with SIPs. Another important feature of ULIP is there is an enforced discipline. There is a compulsory lock-in period of 5 years. That's why ULIPs tend to perform better, because the fund manager have a clear horizon of 5 years. They don't have a exit demand for the funds. So the fund managers can tend to invest for a really long period, and that's why ULIP tends to perform better in a longer time period. SIPs are very flexible and liquid. You can decide when you want to start, when you want to stop. Who should choose ULIPs? People who are seeking dual benefits, people who are looking for tax efficiency, people who are looking for disciplined long-term investments can definitely go for ULIPs. And who can prefer SIPs? People who prefer people who intend to do pure wealth accumulation. They want to have a high liquidity preference. They are very cost conscious. They don't want to incur any expenses on the insurance part. So the conclusion is no product is absolutely right or no product is absolutely wrong. Each product has its own pros and cons. One can select as per their requirements.